In finance, beta is a single number that tells you how much your investment likes to follow the crowd. If the overall market jumps, does your stock politely clap from the sidelines, or does it cannonball off the cliff right behind it? In simple terms, beta measures volatility compared to the market. The idea came out of the 1960s, when finance professors decided that risk could be expressed in equations instead of just sweaty palms. They wrapped it into the capital asset pricing model, a fancy formula that pretends risk and return can be perfectly balanced like a spreadsheet yoga pose. So how does it actually work? Imagine the S&P 500 is your benchmark. That's the average market. If your stock has a beta of 1, it moves in sync with the market. If the S&P goes up 5%, then your stock probably goes up around 5%. A beta over 1? Your stock's got extra kick. If Tesla's rocking a beta of 2 and the market jumps 5%, Tesla might blast off 10%. But when the market drops 5%, Tesla loves to faceplant twice as hard. A beta under 1? That's the Zen zone. Think utility companies. The market can throw a tantrum and they're still just sitting there, quietly handing out dividends like your boring, reliable uncle. And then there's the mythical beast, negative beta. These things move opposite of the market. Think gold or some hedge funds doing wizardry. When everything else is on fire, they're over there roasting marshmallows. So how do you actually use beta? Investors use it as a risk vibe check. High beta means big wins in bull runs and big tears and crashes. Low beta means less thrill, fewer panic attacks, and way fewer calls to your therapist. But here's the catch. Beta only measures past volatility, not future disasters. A stock can look safe with a low beta, right until the CEO gets handcuffed on live TV. Beta also assumes the world is linear and logical, which is hilarious considering financial markets behave like caffeinated squirrels. So what's the takeaway? Beta is a quick shorthand for volatility, a way to know whether your portfolio will act like a roller coaster or a merry-go-round when the market gets dramatic. It's not the whole picture, but it's a useful piece of the puzzle. Because at the end of the day, beta answers one question. When the market sneezes, does your stock get a sniffle or a full-blown pneumonia? This has been Beta Explained in 100 seconds. I am your host, Mr. X Banker. Thanks for watching, and I'll see you in the next one.